If you find any strategy at all involving buying options which doesn't lose money, you should do that strategy. Even if it doesn't make money. If it doesn't lose money in your long options, that thing is gold. Because when the world goes to pieces, those things will always kick in. Having a stock as a disaster hedge makes perfect sense. So in this case, if you're going to win 85% of the days, but you win $1, and 15% of the days you lose $5, you've still got a positive expected value. But you're like, oh shit, I don't want to lose $5. I'm happy losing $2. You can't really turn something that has a certain kind of risk into one that doesn't. You can't turn a negatively skewed trade like that into a positively skewed one. People are making statistically the right bet, but often they don't understand why it's statistically the right bet. For example, oh, I lost money on this day, I have to widen out the strikes. Or I lost money on this day, so I don't do a condor, I do a broken wing butterfly or something. And none of that changes the distribution of their results. The fact that people thought that there was something magic about that particular time, that's a real red flag. And if it only works at 9:20 and it doesn't work at 9:30 or 9:40, then you haven't found an edge. What you found is luck. I think that trade is fine if you can limit your risk on each trade. That would be one of those trades that I think you could structure a career around.
Today, we are joined by Euan Sinclair. Euan is a professional option trader, former market maker, and one of the clearest thinker on volatility and risk that I have known. With a background of physics and decades of real experience, he's authored highly regarded books on options that I usually recommend people when they come to me, and is known for breaking down ideas into simple and practical insights. He has worked and shaped how traders think on edge, volatility, and survival in the markets. And today we are excited to bring that perspective to the real audience of Indian markets. Hey, welcome, Yuan.
Oh, thanks for having me. That was a great introduction and made me feel great.
Did we miss something in your journey that probably would help an Indian retail trader, understand you better?
Well, hopefully they will know me a little better after this. Like you said, I did a PhD in physics, decided I wasn't going to be a physics professor for a couple of reasons, joined a market making firm, market making options, which is a great way to learn about options because you're making lots and lots of trades. And market making's kind of unusual in that it's very easy to make money as a market maker because you're collecting the bid-ask spread, but it's really hard to keep the money because you're always trading against people who know more than you do. So market makers become very good risk managers. And the way you need to do that in options is by understanding all the little wrinkles and things that can go wrong. So I think it's a very good background to learn a lot about options quickly. And from there, I went into various quant roles, management, risk management. I left for a little while to run a fintech startup. And now I'm working at an ETF management company where we run basically a market timing ETF to try and beat the S&P 500 using machine learning models and option overlays. And it's gone very well, actually. It's very different from what I've done before, and it's different from what I talk about in my books, because in the books, a lot of it's aimed at retail. It's the idea of keeping things simple, whereas what we're doing is much more detail-oriented. But so I guess I should emphasize when I say keep things simple, it's simple as possible, not oversimplified.
From what I have learned about you over the years, is that you have talked mostly about how trading is mostly about an edge, right? So I want to get there first before going other places. So could you explain me what exactly an edge means when we come to trading derivatives and specifically options as a product?
Okay, so in general, an edge just means you have an advantage over your opponent. So that's true of any game you play, right? If you're playing chess against someone, your edge would be that you are a better player than they are. If you're gambling, your edge is that you know something about the game they don't, or maybe you've got, I don't know, loaded dice, an unfair coin. It's a statistical advantage. And the mathematics of it basically means that your average expected value. And it's interesting that average, the original term for it was expected value because it came from gambling. Probability was derived from the gambling world. So expected value, which has to be a positive number for you to have a chance of making money in the markets, is literally the average of all the outcomes. And I think it's quite easy with options in particular for people to forget that really simple thing because they get wound up in all the Greeks and all the mathematics. And it all comes back to you have to sell things for more than they're worth, or you have to buy things for less than they are worth. And if you don't do that, nothing else you do, no risk management, no psychological abilities you might have are going to help. And I think if you put it in the context of running a shop, you buy things retail and you sell things wholesale. Like shops don't buy and sell stuff irrespective of the price. And it's got to be like that as a trader as well. You can't make money by selling things for less than they're worth. So in options land, that basically means you have to have some estimate of what things are worth.
At a retail side, so let's say I have a small retail in India who's doing this for a living. What I'm asking is the money comes basically from just my ability to take risk, or if I'm not forecasting it right, if I'm just balling it right now, because most of the money that goes into an Indian retail trading just becomes like a perpetual, let's say, a short gamma book or a selling option book, or a perpetual trying to scalp some amount of spot using options buying.
Yeah, well, this is one of the things that's difficult about options or trading in general, right? The one big determinant of any single trade you do is luck. But over time, you can't make money through luck. And it's worse than that. Over time, if you have no actual edge, you're going to lose money. Even if on average you only have zero edge, because the costs are enormous. And this is particularly a problem when you're trading very short dated options like zero DTEs, because the edge in dollar terms is very small, but the costs relative to that edge are huge. So sometimes people think that you don't have to be as good to trade zero DTEs, but I would argue you have to be better because the edge is so small. But so go back to your situation where you said one of the things, everyone's running a perpetual short gamma book, right? So they come in every day and they sell stranders, or they do iron condors, or they sell straddles or whatever. By doing that, they are implicitly making a forecast. Their forecast is that the volatility at which they sold those options is too high. Now that's good enough. When I say make a forecast, I'm not saying that, implied volatility is 20, I think it should be 13.8. That you don't have to do that. But what you do have to say is implied volatility is 20, I think it should be lower than that, so I'm going to sell it. And whether you think that's what you're doing or not, by doing the trade, that's the bet you're making. So the only forecast that's consistent with your bet is that volatility, the implied volatility, is too high. Now, luckily, for most of the people doing that, usually implied volatility is too high. So that's one of those things where people are making statistically the right bet, but often they don't understand why it's statistically the right bet, which means they can get into trouble when they lose money because they'll start doing things that are really unrelated to where that edge is because they think, for example, I lost money on this day, I have to widen out the strikes. Or I lost money on this day, so I don't do a condor, I do a broken wing butterfly or something. And none of that changes the distribution of their results. And like I said, it absolutely changes the result of any one trade. But the overall risk factor you're taking a bet on is the same. You're saying volatility is too high. And once you've got that major viewpoint, you can express that in lots of ways, but that's of greatly secondary importance. And I think one of the problems with options is, first, people don't understand they're always trading volatility. Sometimes they, I don't know, they think I'm going to sell these options because options decay. But as you know from the Black-Scholes equation, that literally said options do not decay. It's that phasor thing says if nothing else happens, options lose money. But of course, something else is always happening. So I think people get that mixed up. And then I think they spend way too much time looking for like a magic structure. They're like, oh, you've got to do a broken wing butterfly and you have to do it 25 minutes after the market opens. And there's no magic structure and there's no magic time at which to enter. It all comes back to that. Is volatility too high or is it not? And if you get that basic forecast right, it is of very, very diminished importance exactly how you trade it from there. It's not unimportant, but it's a lot less important.
We haven't talked about right now how volatility is usually more expensive. So that's what a lot of the money that if you sell perpetually options, you're making money from.
Yes.
We have, at least in the Indian markets, I can talk about it. We have seen this risk premium degrading over the years that I have been trading, and a lot of my fellow traders have also been trading. Right. So, can we consider that this degradation in risk premium that we are seeing is mostly because of how more people with a faster edge, or probably, let's say, someone like Jane Street is coming to Indian markets? We've talked lot of talks about that, right? Or is it because a lot of is getting upped away from like a lot of people are getting better at just figuring out what the price should be rather than what paying the extra premium for it?
Yeah, and there are a bunch of things going on, and India's an interesting case because it's very heavily dominated by retail. The US has become much more retail friendly as well, but India's still ahead in that regard. For a long time, it was very hard for foreign companies to get involved. Like, so you had to set up an actual Indian entity. Like, we as a trading firm cannot just turn up and start trading Indian stuff. Barriers to entry were really high. So before the foreigners came in, and I don't mean foreign, the Jane Streets, the Susquehannas, the market was probably more mispriced than it should be. And there probably was this idea, developed markets, sometimes they're just less efficient. So there was probably some of that to a degree. But also, risk premia in general are always time varying. They always come and go. And some of that is because there are periods where options aren't overpriced. It's like, for example, over the last 2 or 3 years, 25, 30 delta calls in the S&P have actually made money because the volatility was very low and the skew was high. You're buying them below fair value, which is crazy because usually I would say they are the worst options to buy on a volatility basis, because as you go up, volatility gets hit, they get hurt by implied volatility, and you never make any money, whether you're right or wrong. They're awful. But for the last few years, like I said, those things have been very good. They've carried very well. Sometimes that just happens. We've seen very big up moves in the S&P. We saw one today. The 0 DTE volatility on the open was about 10. And we realized like a 1.4% move or something, which is, corresponds to a realized volatility of more like 20, 22. So we do see days like that, and that can persist for years. Like, you're probably not old enough, but around the financial crisis of 2008, there was a decade as a result of that where stocks in the US had not appreciated at all. So that's like the most consistent risk premium in the world is the equity risk premium, and particularly for US equities. But there was a 10-year period where it just didn't make any money. But you wouldn't then say, oh, stocks are never going to go up again. Well, some people do, actually. I had an advisor tell me the other day they thought there was like a 40% chance of US stocks losing money over the next 10 years. And on one hand, I admire this because it's a very aggressive prediction. And, that's more interesting than just going along with the herd. But there have only been 3 10-year periods since like the 20s where US stocks have not gone up. So it's exceedingly unlikely unless something has drastically changed. And I think that's probably true with options as well. Like, the risk premium over time is never going to get reduced to zero. Because if I can buy options for fair value, just the fact that they have unlimited upside and limited downside, that payoff is so attractive. Everyone would do that. And as a result, no one's going to sell you options for fair value. They're almost, because of the convexity, it's begging for a risk premium. So I think one of the reasons you see in the Indian market, it looks like the risk premium has dropped to nothing, is probably because it was just wildly overpriced to start with. But also in the US, the risk premium is pretty low right now. It certainly hasn't been an absolute given over the last few years. So I think that's probably those two effects happening at the same time in India. The market is becoming more efficient, and sometimes options are cheap.
Yeah. So you talked about how the variance risk premium or equity risk premium, let's say, it's just being long your index, your benchmark index, probably could be stalled for 10 odd years. Let's say, yeah. So we have seen the same happen in India right now. We are at the same levels that we were 3 years back. No saying how long can we be here. For someone like me who is doing this for full time and also probably, let's say, in my early 30s, uh, how do I build a career just if most of my book is just running around risk premium? So let's say I am long uh, ERP, and then most of my cash flow is generated by VRP and doing stuff around that. So, like a 10-year haul like that would be very detrimental to my career as a trader, specifically early on, since my cap also has not increased drastically. That I can probably survive on a lower variance or a lower return profile.
Yeah, it's not very reassuring, is it? Like 10 years, it's easy to look back and say, oh, the 1970s were tough for stocks, but it's much harder to live through that 10-year period. And whether it's your own money or whether you're running other people's money, if you don't make any money for 10 years, you basically, your career's kind of greatly diminished, or else you get fired, right?
What?
You can explain all you like. Oh, I've still got edge, but eventually people get sick of you. Um, I would still say that if you think of the various kind of trades you do as part of a trading pyramid, like the food pyramid. So in the food pyramid, right, you're meant to eat mostly, grains and vegetables, and then the next level up is proteins and so forth and so forth. I have no idea if that's actually the right level, right? I know that proteins go above grains, but I don't know what's in the middle. Um, I think you should think about trading in the same way. Risk premia are the most reliable thing. Either they come and go, like I say, and by the way, the variance risk premium has never had a 10-year period where it didn't pay off. So it might have a 2-year period. And I mean, I'm not saying that's perfect, but it's better than 10. So you think of risk premia as kind of the base of your pyramid. And no matter what else you're doing, you should have those on because they tend to be consistent and they tend to not require an enormous amount of intellectual energy. If what you're doing is, well, collecting the equity risk premium, I mean, buy and hold will do that. So that should be part of everyone's portfolio. And I think traders sometimes overcomplicate these things because they're like, well, I want to buy and hold. I'm going to time this and time this and time this. And with a risk premium, you can get 90% of the benefit of it just by being in the game. So at my current job, like I said, we've got this ETF. We have 12 financial engineers. Half of them got PhDs. We've got enormous computing power. We are spending all of this time and effort to try and beat the US market. And we have, but we've beaten it by like 2% a year. That's a huge amount of effort to make a very, very small increase. So if you're like a independent person, the thing to do is to get 90% of it for the least amount of work. So just put that money in a buy and hold situation, move on to the next thing. So the next level might be something like futures carry trades. And it could be, you could be doing that in the currencies, you could be doing it in ags. Carry is a very, very persistent way to make money. And again, it's very low touch. Um, a lot of people do VIX trading and they think of it as a volatility trade. And it really isn't. It's really just a general carry trade that happens to be in the VIX, in the volatility space. And the reason it looks so good is because the premium in the volatility space is so high. But that could be the next level you're looking at. And then after that, then you could do volatility premium harvesting by selling strangles, and do that on a diversified group of assets. Do it on bonds, do it on the VIX, do it on S&P, or in your case, I guess, Nifty or whatever. So that's the basis of your trading book. There's like these 3 or 4 things. Then maybe 30% of your trading book goes into active trades where you're looking for inefficiencies, looking for genuine alpha. Because, traders are always talking about, I've got alpha, I've got alpha, I've got alpha. And most of what they've got is leveraged beta. And that's fine. Your bank account doesn't care if it's beta or alpha. It's just, did you make money or not? So I think most traders neglect that leveraged beta component out of pride or something, or they think looking for these inefficiencies is the fun part. But most fun things aren't the things that'll make you money. You generally get paid money for doing something that's sort of crappy in some way. So
Yeah, I think that part of finding an alpha and trying to just be on the lookout is something that I think basically excites more trader. It's more than the money; it's just the journey to finding something that you probably think that at least you in your surrounding and in your area of expertise that you are probably the only one who has got it. So
well,
more than the
I have wasted so much time doing complicated things that I thought were interesting. Like one of the things is, and I'm not the only one, right? Tons of academics are still trying to do this, but I think all of the good traders I know do really simple stuff and do it well. That's why I don't think of myself as like a particularly good trader. Because to be a really good trader, you find one thing and you just hammer it. And it can be the most boring thing in the world, but traders don't care. And they'll do that for 20 years, buy their massive house and they're done. Whereas one of my big weaknesses is I do things that I think are interesting, like trying to price VIX options consistently with S&P options. And there's a huge amount of academic literature on this stuff. And, look up Julian Guion or Jim Gatherall. None of it's particularly helpful, but it's this kind of intellectual, I don't know, it's like a black hole of intellectual curiosity that you get sucked into. And that's really detrimental for traders. You really have to, as a trader, just focus on hammering out. It's like you might be trading financial derivatives, right? But really all you're doing is buying and selling stuff. So 1,000 years ago, the people who are now good financial derivatives traders would have been working on a salt caravan or would have been trading fruit or fish or something. It's all the same thing. You're always trying to buy low and sell high. So don't get too wrapped up in the fact, oh, I'm an options trader, so I trade options. I mean, the really good traders I've known, when they've seen an opportunity in something outlandish, just dive into it. Whereas the good traders I know, I mean, of Andrew Mack, obviously, who's possibly the best retail trader I know. I hate saying stuff like that because I don't want to jinx him. I don't want him to blow up or find out he's never actually made any money. He's lied about all this stuff. I'm not saying that that's not true, suppose. Don't cancel me, Andrew. Um, but what he does this all the time, he's really good at it, is following everything that's happening in the world and just looking for the easy money when it happens. Because there's always easy money. You've just got to look for it. And that's the retail's big strength is in my world as a pro, I can trade one thing. I can trade SPX options and I can trade the VIX complex because that's sort of the same thing. That's it. It doesn't matter what my opinion is on the NASDAQ. I've got a very, very limited universe. I know a lot about that limited universe, but I'm a one-trick pony. It's a good trick, but it's just one trick. Whereas if you're a retail person, your big advantage is you can trade anything. So not only is that your advantage, it's an option you've got. That switching option you have to use. Because if you don't go looking for the easy stuff and dive in and out, you're going to find yourself competing against the pros who know more than you do. So that's what you've got to do. You're not going to be an expert as a retail person, but you have to be a generalist. And you have that opportunity. That's what you have to do, though.
I totally relate to the fact that you have been talked about that if you are good at one thing, then you probably hammer it till you are done, right? But most of the concern that for someone like me comes around when there's a period where it doesn't work, and then I try to get into that mindset that probably was it just a numbers game, and probably I got into a series of samples where the whole sample of data was working in my favor, or or was it was it something that I was doing completely right and then probably would make me money for a couple of more years, right? So that's what one of the reasons that probably a trader like me and other people as well usually diversify into multiple cross assets so that even if we get into a phase where the main cash making stuff is not working, we still can justify, it's okay, we're not making as much returns that we probably do, but something else is working. So I also figured, at least from my trading, I've heard you also say that most of uh, my book is mostly short gamma, like selling options and making money through it. It could be in stock options, it could be in index options, it could be probably in commodities or some other place, right? I've also figured over the couple of last few years, but most of my money is being made around long gamma, let's say, being around events, being around earnings and other stuff, right? So I would want to know from you, what would be a good metric for someone to actually figuring out when size up that long gamma side of the book, or probably when to be more cautious on the short gamma side.
That's a really hard question, isn't it? And it goes back to your even bigger question. How do you know you haven't just been lucky? How do you know you weren't just in a hot period? Because you're only ever going to do a trade if it's worked for a while, right? Because either someone else has told you about it, or else you've back tested it and you've seen it and it has worked. It's always, there's always more than statistics, because the statistics will tell you this has worked, right? But then it comes down to you, do you really believe this thing? So, and this is beyond statistics. It's kind of a meta level above that. It's like, how much faith do I have that the statistics are telling me the truth and it hasn't just been a lucky period? And that's sort of I think that's part of the art of trading, is you have to learn how to sort of put that weighting on things. So no matter what my Kelly ratio is telling me or whatever, or however you size things, I always have a big discount factor, as in, do I believe that this thing's true or not? So like, if 10 is the thing I believe 100% in the world, which is stocks go up, and 0, which is, I don't know, some technical analysis involving patterns that look like cows or something, that's 0. Everything else is sort of in the middle, right? So I don't know if you remember, maybe a couple of years ago, there was this chatter about gold goes up on Fridays. So this was this big thing, and everyone was arguing about it. And like, yes, you looked at it, and for the last 3 years, gold has gone up. If you buy it on Thursday night and sell it on Friday morning, you've made money. And you're like, yeah, that's absolutely true. If you look at the numbers, that is indeed what has happened. But do I really believe that that's actually a thing, or do I believe that that's just something that we've happened to have seen? Because you look at enough things, right? You're going to see something like that somewhere. Like, I don't know, maybe Tesla goes up on Tuesday afternoons, and it doesn't mean anything. It's just I've looked at a million things and that turned up. So, you have to sort of discount things like that. So on the gold one, I'd say that's probably like a 3. So would I trade it? Yeah, probably, because it's very unlikely if you think you've found an edge that you've found negative edge. The edge isn't just floating around, right? And it's as hard to find negative edge as positive edge, for obvious reasons. So what you've probably found is zero edge. So there's not as much harm in trading something with no edge as long as you really monitor the P&L and you see what's happening and don't fool yourself and keep track of all the transaction costs and everything like that. It's okay to take shots on stuff like that, because you always have to. It's always a confidence thing. So I will often trade in my PA, trade stuff like that, but I'll trade it small. And if you find you don't believe something very much at all, it would be so small that it would be just a waste of time. So that's kind of like the magic rule for sizing, is it should be big enough to make you some money if you're right. But if you lose money, it shouldn't be a disaster. And if you can't find that magic point, then that trade's just not for you. So that's sort of the major problem with trading is, how do we know? We might have been lucky. But the reason I don't trust the gold thing, for example, the reason I trust the equity thing to start with, right? Why do I think that's so, like, set in stone? Well, the first reason is the statistics are incredible. Right? We've got stock data going back to the 1600s. We've got it for hundreds of different markets in dozens of countries. People have studied it very carefully, including inflation, including survivorship bias, all of this stuff. It's inarguable. Stocks go up. And they go up more than they should based on the amount of risk you're holding. And that it's a big enough thing, the equity risk premium, that academics spend their entire life studying it. And if you think on the fundamental side of it, it should be like that, right? Because a stock is a little bit of a company, and a company is a thing where people are literally trying to make you money. So you've got people trying to make you money, and you are participating in their business. Of course, stocks go up. So that's a 10. The gold thing, all right, well, the statistics are there, but why would gold go up on a Friday? Well, then people start sort of looking for reasons, because you kind of need reasons. And they're like, well, people like to hedge their risk over the weekend, so they buy gold because it's a hedging asset. And I'm like, okay, possibly. Can you give me an example of some of these people? No. No one has ever told me this hedge fund, this fund manager, this person who's trading hundreds of millions of dollars does this every Friday. Like, no one trading big money turns over a significant chunk of their position every week just to hedge risk. It's too costly. So I just don't believe that. And that's sort of an example of, you've always got to put that belief factor on the top, and you'll never see that in the statistics. You're only ever going to look at statistics of things that work. So that's a terrible answer, but it's the only answer there is.
I've seen something like that happen to the turn of the month trade as well. Turn of the month trade, where we used to go long around the end of the month and then probably till the early start of the next month, used to work really great for many years. In the last 3 years, we have seen a very stalling period where the net returns have been net negative, while the index is usually slightly up, right? So, so it becomes like a very self-questioning kind of a moment that, oh, Is it the data, or probably, or did I miss something in my perception that a lot of the flows come in at the end of the month? So yeah, we saw that happen a lot around turn of the month, at least in India.
Well, I mean, I haven't done any analysis on the Indian market, but I've studied this quite a lot for the American market. It's actually one of the factors in our multi-factor ETF model. We have a lot of seasonality effects in there. And over the last, I don't know, 15 years, what used to take place over 5 or 6 days now takes place over about 2 days. So the effect has got smaller, but it's also become much more concentrated in time. So it's still there, but it's not as strong as it was. And I think one of the problems, though, is you've got to have a baseline for how good a trade is going to be, right? And even a really good equity timing anomaly like that, if the stock market is on average up, I don't know, 0.04% a day, and on average the variance is 1%, and I think the stock market in the US goes up about 52% of the days. For an equity anomaly like that, you'd be talking about, oh, it doesn't go up 52% of the days, it goes up 55% of the days. That's a big edge. But also, if that's all you're doing is trading that every week, or every month rather, you're going to lose a ton of times. And I think you've got to have a very realistic idea for, if I'm right, how much money can this trade make me? And also, if you know that, you won't overbet. Excuse me. But also, you won't have unrealistic expectations. So even when something like that works, it's a very small effect, which I think is one of the problems with people trying to time the equity markets, is they're looking for like a strong effect. And there aren't any strong effects, because if there were, they'd be too easy to see and everyone would trade them and they'd go away. So it's not like we don't know any effects that you don't know, because there are no magic, unicorns floating around out there. What we're better at than the average retail person is we can take 50 little effects and put them all together. And that's the advantage the pros have, is the ability to manage all these data sources and put it through models and manage the logistics and stuff. And I think the average retail person thinks that, oh, all I've got to do is track insider sales, or all I've got to do is look at the price of copper. All I've got to do is look at shipping rates. All of these things matter, but none of them matter enough on their own to make any money. That's sort of, you've got to have a realistic expectation. And I think a lot of people go wrong at the start because they don't. They think they'll make, 1% a day. And you're like, really? Annualize 1% a day. You really think you're going to make 300% a year. But if you say 1% a day, it sounds small. And I'm like, oh, I'm not being greedy. I just want to make 1% a day. It's like, okay, you're not being greedy, but you want to be 5-6 times better than Jim Simons was. Okay, fine. Probably not going to happen, is it?
I hear that a lot, at least at the retail side of Indian markets. I know you have heard about the famous 920 thing that went on in Indian market for quite some time. Still working. A lot of people are still punting on it. Most of the retail volume is also there. It's on the expiries and zero DTs. We used to have every day. Now the governing body has curtailed it to two a week, because they saw the volume as some systematic risk. But still, almost, like, if I have to talk about, I think 80 to 90% of the retail volume is structured around those zero DTs, and mostly trades like the 920 itself. So I would want to take your opinion on it. Is that flow, or is, let's say, if that structured trade, is it a trap for retail, or is there genuinely something around that that probably would work for a long time before degrading it so much that you can't call a career out of it, right?
Yeah. Okay. So that's all that is a classic variance risk premium harvesting trade. All you're saying is implied volatility is too expensive. The whole, the fact that people thought that there was something magic about that particular time, that's a real red flag. Because to me, that tells me that they don't understand really what the risk factor is that they're making money from. They think there's something special about that time. And if it only works at 9:20 and it doesn't work at 9:30 and it doesn't work at 9:10 or 9:40, then you haven't found an edge. What you found is luck. But that so this is one of those things where the actual trade is the right trade usually, because it's a variance risk premium. And you're saying options are too expensive. And yeah, they usually are. But you're also demonstrating that you don't really understand what's going on. And that's where the danger is. When things are going well, that's fine. But when things are going badly, that's when you say, well, I can't get in at 9:20 anymore. I have to get in at 9:25. Or I can't let this thing expire. I have to cover it 4 hours later. Or I have to do this, I have to do that. And you start messing around with it. Whereas I think that trade is fine if you can limit your risk on each trade, doing condors or putting stops in or whatever, and you just do it small. That would be one of those trades that I think you could structure a career around. But it's not the only thing, because you'll lose money occasionally. And honestly, your losses are going to be way bigger than your wins. But I don't know what the statistics are in India, but if you did that sort of thing in the US, you'd probably win about, I don't know, 85% of the days. And that trade over, if you can stay in the game and not blow up doing that and not messing around with it too much, yeah, that over after 5 years, you're almost certainly going to be ahead. Where you'll screw up is by thinking you're a genius and starting to trade too big, or messing around and changing things, or giving up when something's happened. But I wouldn't put all of my money into that. I don't think it's that one thing you need, but certainly it could be part of a portfolio. Um, I don't see there's anything intrinsically wrong with that trade. I might, though, if everyone else is doing 9:20, I might actually not do that time, because if everyone in the world is piling in and selling at exactly that time, that's going to create an imbalance. You might want to look at the actual order flow at that time and see if anything's there. You might want to wait or get in early. Excuse me. But yeah, I don't see anything wrong with that trade. I just see it's one of those things that's the correct thing to do, but people probably don't know what they're actually doing, which is where things get dangerous, right?
Yeah. You talked about stops on these. Most of my concern with a strategy like that or with the stuff like that is around having aggregated stops of if a lot of people are doing, let's say if a majority chunk of retail is doing it, right? And they also have stops. They don't usually rebalance this stuff. They just stop it. Like they have a hard stop placed on the exchange itself, at the exchange level itself. So most of my concern is if I know a certain amount of flow probably might come at that instance where probably it's like if a bunch of the trade is coming at a lot of people, and that I think probably also would have been one of the reasons why Jane Street was very successful in Indian markets. They could predict the flows of a lot of retail coming in at 0 DT. So if that is my concern, how do I get over those concerns of using a stop versus someone like who the whole market where I do not get capitulated by the whole market itself?
Yeah, it's a good point, and I imagine they still do, but I'm not in this world anymore. But back when there were floor traders trading futures, hunting for stops was a really big thing. I mean, that was a legitimate strategy. If you could set off a string of stops, um, you could obviously profit from that, because you bid the market up till the stops get hit, the market gaps way higher, and you sell way above it, and you're happy. So that is a legitimate concern. But I think you've got to put that up against the unlimited risk you would have if you didn't have that. So yeah, you know what? That's sort of the cost of doing this insurance. Is it perfect? No. In general, I don't recommend people use stops because I think in general they're overused. I think most people use them because they don't want to lose any money. And if you're trying to collect a risk premium, you have to take risk. So in this case, if you're going to win 85% of the days, but you win $1, and 15% of the days you lose, I don't know, $5, you've still got a positive expected value. But you're like, oh shit, I don't want to lose $5. I'm happy losing $2. Well, at that point, you're going to stop yourself out a whole bunch of trades that would have come back and been winners. And you've got to, at a certain point, you've got to be aware of the risk profile of a given trade and then say, am I happy with this? You can't really turn something that has a certain kind of risk into one that doesn't. You can't turn a negatively skewed trade like that into a positively skewed one because you're getting paid to take that risk profile. That's why that variance is there. That's why you're making money. So you can't make the money and also get rid of the risk. But where you should have a stop is not, it shouldn't stop you out so you're like, oh, I had a bad day at work today. You've got to deal with that. It should stop you out though, oh, I've just lost my house. I have no money left. I'm bankrupt. Having a stop as a disaster hedge makes perfect sense. So I look, it's like everything, right? There's no perfect thing. There's no thing that's always right. There's no thing that's always wrong. Stops have their place. I just think most people tend to overuse them. But if I'm trading zero DTEs, I would certainly have some sort of automated exit, whether it's I bought teeny options, or I've got to stop in the underlying, or I've got to stop in the option. Hopefully that would only get triggered maybe once every month. You don't want it getting triggered. Well, now you've only got it twice a week, right? So maybe it only gets triggered once a quarter. If it's getting triggered every week, you've got it way too tight. I mean, these sort of stops shouldn't come into play very often. But I also wouldn't be completely just naked short these options because eventually you're going to blow up if you do that. And that's a bad reputation selling options have. People are always like, well, eventually you'll blow up. But you don't have to. I mean, just because you're selling options doesn't mean you have to be naked short options. It doesn't mean you have to be unhedged. I mean, I've been selling options now for 30-something years. I mean, having said that, I'll probably blow up tomorrow for something, but I haven't blown up yet, and we've had some pretty big moves. So you can always hedge those disaster risks. You just can't hedge you have to be prepared to take a certain risk profile. So going back to what you said at the start, yeah, I think that's a great trade. You should do it.
Like when we're talking about hedges, I also have this question. We know for a fact that tail puts are slightly more expensive compared to the calls, or at least the skew. Most of my book, at least, is hedged by using the quarterly puts that we buy to just hedge our net exposure, because we also pledge our assets like equity assets on the market and then trade over it. So it becomes like a double edge leverage on the downside, where I'm losing on my equities as well, while also probably using on my VRP trades and most other trades, which are usually have a slight bit of long bias to it, right? So, is there a better way to do it? Let's say you also talked about how the 20 render calls have been slightly better past couple of years, but not had been the worst performing uh, thing in many years before that. So, is there a way where I could probably, rather than let's say buying puts, probably could be selling calls, buying calls and then selling futures and doing it? What would be the best probably way to hedge a book according to you right now? And also, if done, is something similarly probably done on zero DT? Like where do I do that?
Yeah, see, it's a good point, right? Because when you're buying a put to hedge something, if you didn't have something to hedge, you would never buy that put. In fact, you'd probably look at it and go, oh, I should sell that put, because those puts you're using to hedge are more overpriced than the ones you just sold. So there's something wrong about that idea, right? You don't want to hedge something you sold with something that's even more overvalued. So there's two basic ways I would do it. The first is to buy, well, first, going back to our risk premium layering thing, if you find any strategy at all involving buying options which doesn't lose money, you should do that strategy. Even if it doesn't make money, if it doesn't lose money in your long options, that thing is gold. Because when the world goes to pieces, those things will always kick in. And that's one of the reasons I like the buying options on stocks before earnings get paid out, because like the 2 weeks before, because historically doing that has made money. And that's great. But more importantly, your long options, and if the world, if you have a, event like we've had like last April or in the last month, those things just pay off when the rest of your book's not paying off. That's magic. There aren't many of those strategies. But if you find one, and that one is one, then go for it. The other thing is, when you buy puts, you should be buying the ones that are cheapest, which sounds sensible, right? People often get confused about this, and they think in dollar terms, and they think, I'll buy some 0 DTE teeny puts because they only cost a very small amount in dollars, or whatever your currency you're thinking is. That's not the right way to do it. What you want to do is buy the ones that are least overpriced in volatility terms, because volatility is all that matters. And typically those ones will be the long dated options. So when you're looking to buy options as a hedge, buy them. Okay, so normally the shorts in my book would be between 1 week and a month. To hedge those, I'd buy options between 3 months and 6 months. You don't want to buy options that are like 5 years out, because they really don't react much at all. But the further out you can buy them, the less of a variance premium there is. Similarly, even if you're short 10 delta options in the front month, you don't want to buy 10 delta options as your hedge, because they're still overpriced. But there's nothing wrong with buying 40 delta puts, because in a crash, those things are going to help you as well. So buy things that are closer to the at the money, buy things that are longer dated. Now, obviously, this depends on whether the calendar is upward facing or downward facing or whatever, but that's a general rule of thumb. Another thing that is kind of helpful is selling puts and the VIX. VIX, if you sell puts on the VIX, you become long VIX, obviously, directionally, which means when everything goes to pieces, you spike up and you'll make money. Yay. If nothing goes wrong, you'll probably go to collect theta on those. Being short those is kind of like being short upside calls in the equities. Usually that's the way you want to be. Usually VIX puts are overpriced in vol terms, and if you don't hedge them, that gives you the directional exposure, which will hedge the rest of your book as well. So when I was short 0 DTEs, 1 month options, I'd typically be long some 3, 4, 6 month options, and also be short VIX puts. The short VIX puts thing is, or if you want to be slightly less, you can always do calendars there as well. You get the same argument. You're selling the short dated puts and buying long dated VIX puts. To be honest, on the downside in the VIX, I'm not too bothered. You're not going to see the VIX drop from 19 to 10 in a day. It might go from 19 to 17 in a day, and it could go from 19 to 80, but it's not going to halve in a day. So I'm not too worried about being short VIX puts naked.
Unfortunately, we don't have a VIX product yet. We had one many years back, but they took it back. So
Well,
yeah,
I think the general idea probably holds as well. If you did the analysis, you could probably make an argument for being short index calls, for the same reason. It's not quite as clean though.
But could I be long index calls and short the index for the same exposure, or will just being long puts make from that gain in volatility
Yeah,
drastically more?
it's having said that about being short equity calls, that's not a good idea because it's a totally different thing, and it's not the risk factor you're worried about. And frankly, had you done that for the last couple of years, you would have lost money. And if you for the zero DTEs in the US, in the last couple of weeks, the legs that have lost money have been on the upside. Like we've had massive rips to the upside. So selling particularly very, very short dated options, you've got big risk on the upside as well. And particularly like today, yeah, after money was 10%, but the 10, 15 delta calls, I can't remember what they were. They were probably like 7% fall, which when you have over a 1.5% move is a pretty big deal. And they're pretty underpriced.
People are really very comfortable, at least in the zero DT space, selling calls because they feel like, oh, the major vol risk, that the spike that usually happens on the put side. But at least from my trading and my whole journaling figure, I figured that the most money that I have lost on zero DTs are usually on the call side, and the comfort that we find on selling calls that we feel like are probably not going to spike up is usually a false paradise.
Yeah, I mean
Yeah.
it's really good that you noticed that. It's a really insightful thing. The biggest losses I've ever had in volatility have been on the call side, being short calls. And it's really tempting, like you say, to be like, well, the rest of my book is structurally short vol, so I should sell calls because if we go up, I'll make money on all this other stuff. Yay. But then you don't just go up a little bit, you blast through them and you lose money in everything. So being short calls at 7% is not it's not a great sort of bet as far as I can see.
Saying that, I would also, since I've noticed you have a PhD in theoretical physics and you are a trader. Most of the traders in India are usually engineers who figured that, oh, like it's way more rewarding and way more scalable to do than something else. And then figuring like, since we already as an engineer, so we probably are accustomed to looking at data as like becomes one and the same thing. We look at this space more like from a data space than a finance space itself. uh, you also said that earlier in the video that doing simple things is far better at the retail level than probably trying to compete with the Janes and Scanas of the world. Uh, I would want to know at what, and since we have also talked and read that edges diminish as you probably go forward and look into it, and then probably have to work on them every time to time to actually figure out how to improve them. So as a retail, what few things can someone do to figure out, okay, this is what I'm doing, I need to improve it, right? I need to this is a very simple things, but adding these complexities probably could make a trade better, which probably would not come even into, let's say, a curve fitting, like that. I understand it gets very thin line to, I'm trying to curve fit the strategy to something else, or probably not. So what few things can someone like me or other retail could do, which probably would not sway way too on the quantitative side, but would also improve their chances of survival in the market?
Yeah, I think the trap a lot of people fall into is trying to really improve one thing. And I think the order I would go in is find 4 or 5 things that you think make money. So, it could be currency carry, it could be selling options on equities, it could be the VIX carry, it could be just long the index, right? So you've got your 5 things. put those together in a way that they roughly contribute the same amount of risk to your portfolio. So you're basically volatility weighting them. Then run that in the simplest form you've got. Keep those really simple. Just read the papers you based it on, read that book I wrote with Andrew Mack, go through the Vega Gang stuff, whatever. Have your 5 strategies, do it as simple as possible and do it as robustly as possible to the point where you're not making any more mistakes. So to the point where you have to rebalance this thing every day, but you're not doing trades in the wrong accounts or you're netting them off against the wrong thing. Doing those 4 or 5 things consistently and well is where 80 or 90% of the risk of the magic is. Then you can start to improve each of those things. So having 4 or 5 things that work at like 80% of their perfect level is much better than having one thing that works at 95%. And also it's the law of diminishing returns, right? It's much easier to find 4 or 5 things that work reasonably than one thing that works really well. So that's what I would do. And I think that's the opposite thing to what most people actually do. Like, about the earnings trades, right? Earnings around options. Oh, sorry. Selling options over earnings, buying options before earnings. I've just told you what that trade is. But what people will do once they've heard about that trade is they will say, what are the best stocks to sell options on? Should I do it an hour before the close or should I do it 5 minutes before the close? When should I get out? Should I leave it run for a day? And they start looking at all this data and try and make this thing better and better. At best, they'll improve it a little bit. I'm guessing they won't improve it at all because I've been looking at that trade for 15 years and I haven't found any really great improvements. So what you're best to do there is just go, oh, cool, got it. Sell options over earnings, buy them back the next day. Done. Get on to the next thing. And that's especially engineers, I think. Engineers have got a great strength and they're good at working with data. Physicists in my generation were not. Like, I didn't use any data. I was still using equations, solving equations. No one does that in finance anymore. All that stuff's been solved. Engineers are good at computing. They're good at working with data, but they also by inclination tend to build things and they want to build a system. And that's the wrong way round. You do want to build a system, but you want to build a system of very simple, robust parts. You don't want to build a race car. You want to build something very simple that won't fall apart. So that's what I would do. I wouldn't worry about improving the strategy for quite a while. If you go on Twitter, right, well, it's really easy to get the impression that everyone is a quantitative genius. They've got 20 completely uncorrelated strategies, and they've got a Sharpe of 8. No, they don't. They absolutely don't. There aren't 20 uncorrelated strategies. If you've got 4 or 5 that might have a correlation of 60, 70%, that's great. And if you're selling 0 DTEs, even if you do them on different indices, the correlation might not be nearly as high as you think. Like you're doing it, the S&P and the Qs, that correlation is very low on a daily basis, surprisingly. So you don't need many things. So that's what I would do. I would say don't try to improve things. Try to improve your process. Simple strategies done well will always beat a complicated strategy where you make mistakes. Mistakes will cost you way more than improving a strategy will make you.
One other question that I would probably want willing to ask you before we head down is there's a lot of automation that happens now at the retail end, specifically with the new AIs that are coming around. It has become very easy to automate stuff. Would you automate all of your options trading if possible, or which should a retail look into automating all their option strategies? If it is, let's say, systematic in nature. Would you suggest people automating most of it?
I would suggest not automating anything if you don't have to. Automation's a great thing, and the ability to automate things if you need to is huge, right? But if you automate something because you want to, you're losing a lot of interaction with the market. And you learn by interaction. You don't learn just by doing some trades. Completely automatic system. I look in the afternoon and I go, oh, I made $1,000. Yay. That won't teach you anything. The more you interact with all of the levels of the trading process, whether it's the data, the analysis, the execution, the more you're going to learn, particularly with execution. Like, it's really hard to know problems with getting filled and order games and adverse selection. It's really hard to see that from data because your presence in the market's going to change what you see. So I would encourage people to not automate until they have to. Another reason to do that is if you automate too early, you're going to be solving problems you think you're going to have, and they're almost certainly not going to be the problems you actually have. So I like to do things, and when I get to the point where I'm like, wow, I'm just overwhelmed here, I can't type all these numbers in the morning, we have to scrape that and do that automatically, then I'd automate it. But the more I can do until I know what the problems are, that's what I'll do. So the other thing with options in particular is you've got to remember, like with this earnings trade, right, where you sell options before earnings, you buy them back the next day. A single mistake you make in the buy leg the next day could wipe out weeks of profits. Your profit margins in everything are pretty slim, and one mistake can be enough. And there's always going to be an edge case where you make mistakes. Like I'm doing this Delta 1 strategy. It involves the VIX, it involves the S&P. There's quite a lot of data crunching, but then it does just a spread trade in those two things. Does that every day. We've had 5 problems with getting that implemented. And they're all edge cases, right? That's what problems are. You do your best, but then things happen that you haven't thought of. If that happens in the options world, particularly in illiquid options, you're totally dumb. And also, if it takes you 2 weeks to automate something that would take you an hour a day to do, that's not particularly efficient either. So, I mean, I use AI all the time, but you've just got to use it in the same way that you'd use Google all the time, or you use a spreadsheet all the time. It's just another tool, and it shouldn't really replace anything. But then again, maybe I'm just old. I mean, maybe I just like to do things slowly.
Yeah, I liked how you touched upon the point that how at least in the earning trade, I hate the earnings trade. That's one of my most hateful trade to do because of the reasons that you said, that if you mess up one bad execution at a place, the
Yeah,
whole thing goes for a toss for a season. So
yeah,
for me, that becomes one of the most hateful trade because as an execution no, who probably executes a lot on those type, it's very demanding. It's like one of the most demanding trade to
yeah.
execute because the chances of you messing around and you probably, let's say,
It's also
you have to take.
it's emotionally quite difficult because it's basically a risk premium, right? But most risk premium, you just get in the market and you wait. This one's an active risk premium. So every day you've got to go and do 10, 20 different trades. So every day you're going, oh, I lost money there. Oh, God. Or I made money. Yay, I'm a genius. I'm an idiot. I'm a genius. I'm an idiot. And that's a hard way to go through life. Having said that, it's probably one of the most successful strategies I've ever run. That's been going, it goes through bad periods. Like I think one of the last earnings cycles was the worst ever, in like over a decade and a half. but then a couple before that was the best ever. So, you've got to be prepared to just keep going. It is tough.
I mean, from the execution point of view, if you mess up one of them, then things goes for a toss. It was great having you, Yuan. Thank you for giving us time and having a good discussions. We loved the time we spent with you. I am very confident that people trading in India or looking to make it a full-time career would be very happy listening to what you have talked about today, and probably even going back and reading your books and all. Thank you so much for having us today.
No problem. Thanks. I hope I helped some people.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing. Please read the risk disclosure documents carefully before investing in equity shares, derivatives, mutual fund, and or other instruments traded on the stock exchanges.